Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty. I'm doing our weekly housing market update. I hope you all had a great Thanksgiving. Happy Thanksgiving to you again. And I hope you got our Happy Thanksgiving email. I'm going to share my screen here with you and go through all the details. We are seeing a big comeback with buyers slowly but surely, even with the holidays. I'm going to get right into it right now and show you what's happening. If I can get my screen up, there we go. So I wanted to share this with you first. Sorry about that. Allergies are crazy right now. We've got this Redfin article out there. Just don't pay attention to Redfin. They have a lot of clickbait out there. And here's the issue with this. You know, delistings jump 28% as sellers pull homes off the market rather than settling for low prices. Okay, so this is floating around out there along with the other first time home buyers are 40 years old now. Again, that NAR data on that, because you're just going to have a lot of clickbait out there, guys. It's just the way they make money. That study was actually done by NAR and it was put out. I'm actually part of it, National Association of Realtors. But here's the deal: it was a survey, which usually surveys are horrible anyway. But they had sent out over a little over 170,000 surveys with 120 questions on them. Now, how many young people do you know are going to be filling out these surveys of 120 questions these days? Well, there was 3.5% that actually responded. And out of that, they came up with this 40 year old number. Now, the number is closer to 25 to 30 when you look at other data sources. So I want to put that out there again, just to kind of jump off here. Okay. Because I've shown the charts before of all the doom and gloom. There's just doomers out there that are glooming all the time. And I could show you all the charts. I won't waste your time with it, but the actual thing that's going on here is let me just switch this up here. Is yeah, you've got more people delisting towards the end of the year. Okay. The greatest since 2017 and 2016 and all that, and more from since last year. But here's the thing: what do we have this year across the country that was different? We had more inventory. Okay, so you have more inventory. You still have weak buyer demand. There's no doubt about it. Affordability is still a thing. I get it. I get it. I get it. But here's the thing: the biggest difference this year was the spreads got better between the 10-year treasury and the 30-year fixed rate. You had treasury yield coming down. That 10-year treasury tracks with the average 30-year mortgage across the country. It also means FHA, first time homebuyer type loans, are going to be lower. And VA, right now, even if you go kind of with a not that great lender, and not all lenders are created the same, just like all agents are not created the same, you're going to have rates in the fives with VA and FHA loans right now without even getting buy downs or any fancy type stuff, or even what builder incentives, seller incentives, all that. Just out of the box, you're going to get, even with a decent credit score just to qualify, over 620, you're going to be in the fives. Okay. So that we already have loans in the fives. So and with our mortgage broker, I'm going to be putting out, hopefully in about a week, I'm going to be putting out weekly numbers where we'll have charts for you as we're in a rate reduction cycle overall. When Jerome Powell gets out of there, it's going to go even faster. We've got another Fed president leaving in January. That's another hawk that needs to go. But suffice to say, we've had lower rates for a longer sustained period of time, which has been a big difference compared to what we've seen in the past. We've had these, rate dips for a few days, a week, over the last 2 or 3 years, but they're not sustained period of time where we've had this since like summer. Okay. So we've seen demand come back because the rates have dropped. And right now, I'm telling you, this is not a sales thing. This is just if you want to move, need to move, want to buy, right now is always the best time of the year to do that, typically, because you've got end of the year incentives. People want to get things off the books. Builders are offering incentives typically at the end of the year, um, especially in the buyer's market we're in right now in the Phoenix area and a lot of places around the country. So we've had this greater inventory. That means more choices for buyers. That means you're going to have less competition, and they're offering rate. Where sellers and buyers are not only price reducing, where you may save, $10,000 price reduction is going to get you about 80, $90 savings on a monthly payment, whereas 100 basis points or 1% difference is going to save you about 250 to $300 a month, depending on your loan. So right now is why I say, yeah, is it the greatest affordability of all time? No, but it's the best time that we've seen in a couple of years to buy a house with the incentives going on. Okay. We can even get creative, with builders and sellers where maybe they're leaving more, not only lower rates, but paying your closing costs. Maybe you're getting HOA fees for a whole year thrown in. If you're going to be in an HOA, maybe you're getting all the appliances rather than just the built-ins. All kinds of different incentives we're seeing being given to buyers right now. So that's why I say this has been the best year or 6 months, especially now at the end of the year, to buy a home. If you wait, nobody's got a crystal ball. Nobody's got a crystal ball. But if you wait, yeah, rates may get a little bit lower, which you can refinance later. And if you get a buy down, that money's sitting in an escrow account. So you don't even have to pay for the refinance, by the way. But you can refinance later. But the point is, if you do things when everybody else is doing things, now you've lost the advantage. That's just the way it goes in economics and finance and all that. So if you wait till spring, if you wait till even summer, you wait till after you do your taxes. Everybody's kind of, in herd mode and everybody's doing that same thing, thinking the same way. And I don't really know. I mean, there are people who are locked into their homes. There's no doubt about it. They don't want to give up the rate, but a lot of people just don't understand it. You can get a lower rate now. They just don't understand that. So I would like to, offer how we could show you along with our preferred lender, um, or you can use your lender. They could even explain this to you, where they could show the difference between buying now versus waiting, holding costs on maybe not unloading your home sooner rather than later, um, or even lowering your price, but getting a better deal on where you really want to be living right now and purchase if you already own a home, and get all those incentives now, because as time goes on and rates go down and down and there's more demand, there's going to be less and less chance of getting those great incentives where you're getting 100 to 200 basis points, 1 to 2% difference in your mortgage payment, or with rate buy downs, 1, 2, or 3 year buy down type of scenario. You're starting off at a 1.9% interest rate, then 2.9 the second year, and then it stays fixed. You have to qualify for the third year or second year if you're doing a 2-1 or a 3-2-1 buy down, but you're going to stay at that 3.9%. Okay, in that scenario. So I mean, 3.9%. I just, if you understand this, it's a no brainer. Again, if you can afford to go buy a house, some people probably shouldn't own homes. True. So just throwing it out there, if you're interested in really understanding this and really digging into the numbers and knowing, at least you'll know if now or later is better for you. Maybe you'll make out a little bit better on the purchase than you do on the sale of your home. But right now, if you're just looking to buy a house, don't even have nothing to sell, but you're just looking to buy a house, now is the time to get all the deals. Okay. So this is the difference here is we have much more inventory than we've had in these past couple few years here. Okay. Uh, going back to pre-pandemic, and then we see the numbers rise up. Okay. So the inventory got back to normal. Okay. So the delistings always happen at the end of the year. Less people want to have their homes on the market at the end of the year. Now, I will say you do have serious buyers looking. And if you leave your home on the market at the end of the year and it's priced strategically, you do outpace the people who delisted at the end of the year. This happens every year, though. Every year we see a delisting. It happens every year. Okay. If you just Google delistings and look at the AI charts and everything, it'll come up for you. Okay. You don't have to take my word for it. So, looking at the 10-year treasury, because we track this because we want to know where our mortgage rate should be. This number here at 4.10 means we should be somewhere around 6 with the mortgage spread between the 10-year treasury and the 30-year is how it works. The 30-year right now is at 6.1. Our spreads are much better than they were. If this was the way it was just a year ago, okay, just a year ago, if this was where we were, we had the same spread, look at this. See that, guys? Now we're like 7%. Okay. So that's how much lower the interest rate is just because the economic factors have made it different for the bond market, the 10-year treasury, to come in line more with where the normal spread is between the 10-year treasury in the bond market and the 30-year mortgage rate. Okay. The 30-year mortgage rate. So, and as I said here, you could see FHA, and these are just average across the country numbers, guys. With a mortgage broker, especially when we work with, these numbers will be lower. And then we can negotiate the payment you want. We could talk about what payment are you comfortable with. And then we can go and make those kind of offers where the seller or builder is fitting your payment you want for the home you want in the area you want with these buy down programs. Okay. So the that's the deal. Now these spreads will continue getting better, okay, theoretically with the way we're going. So we should see this come in more in a line. The average now is about 1.6 to 1.85 for the spread, or let's just say 1.8 should be the difference between the 10-year treasury and the 30-year fixed. Okay, so we still got at least 30, let's see, about 30. Let's see. Yeah, we should be down. Like right now, we should be down under 5 right now if things were normal. Okay. For this 30-year, but we are for FHA VA. All right. Then you've got your ARM programs. That's a whole nother thing you guys could take advantage of. And they're not the crazy arms of the crash. They're not that. So the inventory story, single family residences around the Phoenix area, almost 18,000, just shy of 18,000. If we take that out, all properties for sale, actively for sale in the greater Phoenix area, we've got just over 24,000 right now. Okay. And that number, let me just slide this over. Okay. That number, let me just pull up my, I've got a chart here I want to show you. Where did that go? Oh no, I can't get it now. Sorry, guys. Let me see if I've got it here. Ah, I just had it. There it is. Okay, sorry about that. We'll get it. We'll get it, guys. Okay, so these are just the numbers around the greater Phoenix area. I want to show you this first before we go on to the next stuff because 81 days closed down market is where we are right now. 4.6 month supply. Now, for below 4 month supply, we're in a seller's market. Okay, I'll talk more about that in a second, but we're getting closer to that. Just about a month ago, we were in 5 month supply. Just actually a couple weeks ago. So we can see that number coming down with the delistings this time of year. Okay, so we're almost back to a more more of a seller's market there. So the absorption rate, this has been much lower than this, so that's actually pretty good. We'll talk about that more in a sec. The average list price is 762. The average sales price is 563. And the list to sales price ratio is 97.7. That means, the sellers are giving up a little over 2%, okay, in their what they're listing to what they're actually selling for. The active listings are down, of course, which we just talked about. The pending are down, but the closings are actually up 2.9%. Okay. So actives down 4.5, pending down 7.7, closed units down 2.9%. This is going to be important. I'm going to show you some additional numbers on this pending, though, in just a second. And then here's all your price ranges. There's actually nothing over 5 million right now. That's actually gone right now this time of year. Oh, and the other thing is, these lender-owned REOs, short sales, all this, nothing crazy happening there. We've actually got short sales down, HUD homes are down. Now up 2% in lender-owned REOs, but a total of 151. Can't just look at the percentages. We got to look at the actual numbers. Remember, after the forbearance from the foreclosures, everybody was like, foreclosures are up, whatever, 30% or whatever. Yeah, but we came from zero because they had forbearance and they weren't allowing foreclosures during COVID. And then you had forbearance for a couple of years after that. So, again, you can't just look at the percentages, you got to look at the actual numbers. And this is a nothing burger when we're looking at even the inventory we have right now, which is down from where we were, 4.5%. Okay. So, these are all the price range brackets right now, and that makes up to 600,000 makes up 67.74%. 600 to a million is making up 18.6%, and a million plus 13.6%. Now here's and then you can see your days on market too here, guys, for each price bracket. Stuff's just sitting longer, especially this time of year. It happens every year. It's a little bit more elevated than it has been, but I think, once we work through some of the inventory going into the new year, we're going to see some big differences. I would advise people, and you can look at this every year in the data. Maybe I'll bring it out, the charts out next week on this, but you can look at it every year. Again, you have this cycle, and you see stuff sits on the market a little bit longer, and then you see when all the properties go on the market. Actually, I think I do have a chart here in a sec. I'll show you. But you can see everybody goes on the market same time. I get it. Kids got to be out of school. You want to move when kids are out of school. Totally get it. You don't want them to have to switch schools or drive back and forth if you move the distance away. Totally get all that. But if you can do things when people aren't, like list your home, maybe, everybody wants to put their home like on the market like March, April, to time it with the school year. Maybe you put it on in, February or January. Okay. Just throwing that out there just because you want to kind of do things when other people aren't. That's how you really maximize your advantage. Okay. So we can see in December, first, as opposed to 2 weeks before because of the holiday. And usually when there's a holiday thrown in there, plus we had, Veterans Day, anytime you have holiday weeks, things get a little wonky. But no surprise that we've got less inventory coming on at 11/25 for the week, first week here in December so far. And then you've got November 17th, you had 1878, but more than last year and a little bit less than the year before. Okay. But kind of right in that range. So you have definitely this inventory story for the whole year, though, where we had greater inventory right after summer because those rates went down and they stayed down. That's the big story. Okay. And also you've just got a lot of pent up demand. You got a lot of people who are just like, okay, I've been waiting and I got to move now. I can't wait anymore. I've got to move for family or job, whatever. So Then you've got the pending sales are down, but the pending 3,500, the 2 weeks before was 3,800. Okay, of course it's going to go down towards the end of the year, but we're up 500 over last year, and we're up about 900 from the year before. So we're seeing again year over year, 2 years back, we're seeing more buyers come back into the market. Okay. And the properties gives us an indicator of properties going under contract. There's more buyers in the market right now. Not a giant jump or anything, not saying that, but it's showing demand slowly coming back as rates drop. And we said this, rates drop below 6.4, you get more buyer demand. Okay, it's just kind of how it works. If we get down around 6, we really see it happening, which we're getting closer. And if we get under that, we're going to see a pretty good tailwind. Okay, not saying anything crazy like 2021, but we're going to see some bigger numbers. The NAR is actually predicting, Lawrence Yun, that we'll see a 14% increase in home sales across the country next year. So that'll be interesting to watch. Realtor.com, they didn't feel like there was going to be as much demand as that. And they're kind of throwing in the mix about a 2% gain in equity, or price gains. You know, that's their prediction. And when you take that in with inflation, it's kind of flat, right? But anyways, that's the story that they're giving. We'll see how it goes. I tend to err on, more bullish. Again, nothing crazy, but I think the 14% makes more sense with rates coming down, especially once Powell's out of there. It's not so much even that they're going to just jam the rates super, super low, although I think they're going to go lower. It's just the fact that they're not going to be hawkish. They're going to be more accommodative. They're going to get to neutral for sure on the Fed fund rate. Not a one for one for the mortgage rates, but their economic models and their policy, and their forward looking is going to be much different than we've seen from the current Fed, who's been basically rudderless with no plan. Okay. Closings, week to week, we see that up 2.9%. Now, again, we can see the closings are at 5389 in November. Um, and then when we go over here to last year, they're up from that 5161, and the year before was 4629. So again, showing more demand from buyers coming back as those rates drop. Okay. So if we go down to the sales price, we could see here the average sales price 563. Okay, in November it was 594. Makes sense towards the end of the year. Again, people are getting more deals and all that sort of thing, like we talked about. Last year was 560, so that's 563 this year for this week. And the same week in 2023, we were at 535. So not giant increases, but certainly increasing there. And the same with the median sales price here, all the way across. We can see that the numbers jumped up. So that is that. Let me pull up um, my screen here for you. Okay. So what I wanted to show you guys was some of these economic factors that we're looking at with housing. Mortgage purchase application index is shooting straight up. Okay. So that means people applying for home loans. This gives us a 30 to 90-day window because the usual escrow period is about 30 days. Plus, people have to maybe sell a house. They applied for a loan. Maybe they're still out there looking for properties. But this gives us an indicator that demand is being driven up, even this time of year. Okay. So that's a good indicator that we've got demand bouncing back with the sustained lower interest rates and people seeing that and responding. Makes it more affordable, obviously. So when we look at 2025 national single family inventory, we saw that for 2025, it went up. Okay. And now it's dropping off. Okay. And we can see that every year, right, guys? See that every year. It drops down, down. Same thing every year. And when does everybody put their house on the market? Uh, we're going to be right here March, April, May, June. Again, this is across the country, so there may be a month difference when people are getting out of school and all that stuff. But then we see it kind of level off and back down. Okay. So what I'm saying is rather than doing it in March, a good tactic could maybe be starting in February. Okay. Um, and that's not just saying list your home after the Super Bowl. That's what a lot of realtors will say. But you could see that going by the actual data, going by the actual data, that would be a good strategy. Again, when less homes are on the market at that period, maybe that's when you want to list because that's when there'll be less competition. Okay. Jobless claims went down, but in the news, we also saw, I'm having trouble with these charts here, guys. Sorry. You saw private employers shed jobs in a surprise decline. Actual payrolls were down 32,000. Okay. So the expected was plus 51. Again, a lot of economists agree. Scott Bessett just said this. I mentioned the last couple of programs that, we had all the economists coming together at a recent economic forum over the last couple of months here. They met, and over 90% of them said it's the Fed fund rate holding everything up in the economy. Okay, you got a capex boom coming, all those things are coming, but it's really that factor that's slowing things down because when people have a business, they need to get capital in order to run that business. They can't do it if the rates are too high for the Fed rate. Same thing goes for housing, and housing touches so many other economic sectors. It's crazy. You've got the loan sector, the banking sector. You've got home places like Home Depot, family formation, just all the things that go along with all that. Furniture, all the things that housing touches out there in the economy is you know immense. It could go on and on about all the things. So the national single family new listings. Okay, um, this is this has been the story this year. Okay, we had for 2025, we had more. If I can get the right data point here for you guys, we had more in 2025 than we had in the previous years. Okay, so looking at that, now here's the price reduction story. Okay, as we had all this extra inventory coming on the market, we had but we didn't have quite enough demand. We had more demand, but not quite enough to keep up with the surge in additional inventory. We had like 1.5 million units right now. People want to talk about the crash out there with the clickbaiters, and you can go back and look at the clickbaiters being wrong for the last, since the last crash. Um, the one and only real crash you ever had. But we could see that the price reductions came into play with all the homes coming on the market. Okay. And just not quite enough demand yet. I think you're going to see more demand coming back next year. I think you'll see people put their properties back on the market if they didn't sell. All those factors are going to come into play. But we actually had, if we look at 2025, 2022, we actually had similar number there. 40, you have 41%, 41%. 2024, 38%. Okay. A little bit lower. And then 2023, you had 37%. So not that far off, but again, it's a supply and demand thing. You've got more inventory, not quite enough demand yet. Rates haven't been quite low enough, long enough. But as this time goes on and people's incomes catch up along with this and inflation comes down, we'll see rates come down. All this comes into play in the supply and demand equilibrium. Okay. Total pending sales. We see 333, and in 2024 we had 304,000. Okay. 2022 277,000, and in 2023 275,000. Let's see which one's higher this year, right? Total pending sales. So we had more sales this year. Okay. And again, it goes up and it goes down every year. It goes up and it goes down every year. Okay. Why? End of the year. Okay. Nothing crazy, but there's people out there wanting to do the clickbait. Okay. But you got to understand supply and demand. Throw that in there, then you got it. The spread between the 30-year and the 10-year treasury has been getting better. You got 2.19 as when this was taken. You got 2.2 in 2024, and up here you got 2.75 in 2023. So, and you could see the difference all the way across this and how much further apart they are. Okay. So that spread and the supply and demand, those are the big differences, okay, for our economic story. Before I get to the Cromford Market Index, I wanted to show you a few other things. When a home sits on the house on the market longer, it sells for less. Okay, so you've got to strategically list the property, the price, and market it properly and present it properly. And a lot of people are doing aspirational type pricing on their properties, and you just right now you just can't do that unless you've just got crazy features that everybody's looking for. But this kind of gives you an idea of why it's so important to strategically market and strategically price your property on the market, and you can see the number of weeks and how much you're going to be losing. The list of sales price ratios go down. Buyer deals come into play right after that seventh, eighth, ninth week. We start seeing these buyer deals and beyond. Okay, super important to keep that in mind. You want to really, I think a general rule of thumb is if you go 10 days with no showings, that's an issue. You might want to revisit, get back to the drawing board and start talking about price reductions and incentives that we're going to be offering. Also, if you've gotten 10 showings, but you haven't gotten at least one or two offers, that's another discussion. Okay. So just some tips there on what to think about. As far as, uh, you know, this is concerned, you can see, selling 1 month versus selling 6 month. These are using obviously just averages across the board, but your net to close and your total reduction is going to be much different. 115,000 and some change, as opposed to 93,917 and some change. Okay. So, and this is based on a 5% reduction with those buyer deals at that point. So, again, these are using averages, what we see out in the field. These are all pulled from that. Mortgage rates by the decade. People always want to talk about different mortgage rates and affordability and all that. You actually had, greater inaffordability. When you look at the ratios, you look at the percentages, you look at the actual numbers, and you look at the actual, and this is based on the number of homes that the price of a home today with 10% down on these payment numbers. But when you go back and dig into the numbers from back then, and you look at 70s and 80s, it was actually more inaffordable, and you had greater price increases during the late 70s than you did even in these past few years that we've had. So again, just keep those things in mind for a reference. The foreclosures and bankruptcies still below pre-pandemic levels. Okay, you can see how this black line here on the chart kind of runs in with the great financial crisis that we had and how that went up. Remember, you had 250,000 to 400,000 homes going on the market every week, and those people, for the most part, were not also buying other properties, right? They were just losing their house. So you had all this additional inventory coming on the market for years, and then you had them losing their home, but these were not pre-qualified buyers like we had since the crash. Um, People did not have anywhere near the equity they have. Most people have at least on the average, it's $300,000 in equity. That's the average home. About just over 40% of homes right now are actually paid off. Okay. And about 80% of people have interest rates below 6%. Okay, so a lot of different factors. You did not have that. The inventory back then was like 4 million. Right now it's 1.5 million. Not even close. And that's even counting, dirt right now that hasn't even been built on or finished. Okay. You want lower prices. You've got to get more building going. Okay. How do you do that? Less regulation for permitting and other things that go along with that. Also, that would also help to drive the price down, not only with more supply, but also 25% of the cost of a builder to build a home with regulation. It's not the tariffs. The thing that impacts the tariffs on homes is about 7%. 7% from Housing Wire and Logomotive Shami is about on the tariffs and stuff. And that's just a one-time adjustment, but it's about 7%. So that isn't really a factor. Okay. Looking at the Cromford Market Index right now, we see this number at 81. Okay, between 90 and 110 is a balanced market. 100 being totally balanced. Below 90 is a buyer's market. Above 110 is a seller market. Right now, we're in a buyer's market. Now, every little community and every zip code and every area, hyper local, is going to be different. There are some areas, some homes that are going to just sell like the first week to 2 weeks. Okay, even at the higher end of the pricing, just because they have all the things and all the features that somebody may want in a particular area that's super hot. So just keep those things in mind when we're talking about this. But this is just a general idea of what's going on in the greater Phoenix area. This gives us a good indicator. Now, this number was in the 70s not long ago. It was down to 77. So we're starting to see things come back. We're seeing demand rise slightly, okay, a couple percentage points, and our supply is still, pretty good. And we want supply, right? Because we want buyers to have options. We don't want prices to, go out of control like they did before, of course. So that's the story with that, guys. Now, I wanted to just give you guys a heads up on one thing here. If you could help us out, we're doing a blood drive with West USA Realty. It's going to be December 8th. Okay. Give a gift, give a gift, give the gift of blood, get a $15 Amazon gift by email from the Red Cross Monday from 9 a.m. to 2 p.m. at our North Phoenix office on 2355 West Utopia Road. That's our main corporate office in Phoenix. You can scan this right here to get a time slot. And that'll be, again, December 8th. That's next week. That's also 8th and 9th. That's going to be the next Fed meeting. So we'll see how that goes. I'm sure Jerome Powell's going to ruin that, even though he may lower the Fed fund rate by 25 basis points is the prediction. We'll see. But he's going to be super hawkish and that's the thing, the forward guidance, right? What is there a stance? Is it neutral? Is it accommodative or hawkish? Is it hawkish or dovish? So December 8th is going to be that blood drive. By the way, the next Fed chair, right? The odds are on Kevin Hassett, which I think would be great. Okay. He's definitely a steady Eddie, knows his stuff, and he understands that we should be at least at a new policy right now, which would put us closer to around 3% Fed fund rate, which again should put our average 30-year mortgage across the country somewhere close to a 5 number. Okay, a little over 5 probably. The way the spreads are right now, anyway. We'll see if they get even better. West USA Realty, just wanted to let you guys know we were just named number 1 best in Arizona for companies, analyzed by more than 100 metrics by Forbes for 2026 America's best in the state companies. So we are certainly proud of that. Another thing I want to let you guys know about is an open house that we have coming up. One of our open houses. It's going to be on this Saturday, December 6th from 12 to 3 in station. That's Gilbert, Arizona at 4303 East Jones Street in Gilbert, Arizona. This is a very family friendly community. This home is phenomenal. It's a 4-bed, 3-bath with a loft, 2140 square feet. There's 2 community pools. It's got a great outdoor turf area, low maintenance, decent sized backyard. Um, and then it's got a pergola out in the back. It's got, I mean, the home shows like a model. You got granite countertops, all the, sleek, high end chef's kitchen set up there with the open, modern concept, great room concept. And this home shows just like a model. Like I said, it's phenomenal. Garage is actually in the back. It's a 2.5 car garage. So hopefully you can join us for that. It's going to be this Saturday, December 6th from 12 to 3 out in Cooley Station. Also, if you guys come out and you're interested, if you're not interested in this community, which has a lot of, by the way, has a ton of family events, uh, you know, it has all kinds of things going on all the time, seasonally, and they have movie nights and all that kind of stuff. So great for young families or people who just want to have a you know uh, uh, a fun time with the family in the neighborhood. There's biking trails, they got playgrounds, all kinds of fun stuff. But this home is beautiful. You just got to see it in person to really appreciate it. It's listed for 600,000. So we hope to see you guys there. And Cynthia and I would be happy to talk with you when you come by. Our son will actually be there too. His name's Andrew. He's a mortgage broker and loaner with Semperfi Home Loan. Yes, he is a Marine. So we hope to see you all there. And if you guys have any questions at all, want to know more about your market and your area, again, no pressure. Just, what we'd like to do is, just be a consultant, be an advisor. You make the final decision, obviously, but we can at least go through 3 pricing strategies that we have. We can look at the comparable sales, what's also pending and what's active. So you kind of have a full range of what's going on there. We'll put together a net sheet for you, whether you're ready to do this now, a year from now, 5 years from now, at least we can start there. You could even talk to Andrew about what it would look like to get a home loan once you get your net sheet. Or if you're just a first time home buyer, he can talk to you about that. We could go through a buyer consultation and what it would take to get your property sold and marketed out there in the open market. And at least that way we can keep you up to date on what's going on, send you weekly or monthly alerts, also give you a more detailed analysis every quarter if you're a little bit further out. And kind of go from there. But information's power, right? So, for most people, their home is their greatest asset, whether they own already or are planning on owning. So we give you the best information possible and keep you up to date as things go along and what's going on with your equity and what's going on in the market. So, guys, we'll see you next time. And next week we'll have some information after the Fed meeting. Thanks.